Today we are going to study MMPC 014 Financial Management, Block 1 Financial Management and Overview, Unit 3 Risk and Return. You see, risk and return, very simple topic, you see. The more risk if you will take, the more return you will get. For example, if you invest money in share market, you see 1 lakh rupees today you invest in share market. Tomorrow your 1 lakh may become 1 lakh 10,000, 1 lakh 20,000, you see, or it may become, you see, 90,000 also. Share prices, you see, go up and down. So this is a risky investment. Whereas if you invest in a bank, you see, bank in our country, all the banks, they pay about 7%, 8% interest if you invest for 1 year. And this your investment is going to be very safe. Your principal will be intact, plus you will get 7% or 6% interest. So risk is directly proportional to return is directly proportional to risk. If you will take more risk, you may get more return. Now, in finance, risk refers to the variability or uncertainty of returns associated with an investment. You can invest money in bank, you can invest money in post office, you can invest money in shares, debentures, bonds, you can invest money in companies, FDs, you see. Good companies, they ask for money from the people and they pay slightly more interest than banks. But if it is a good company, your money will be safe. Say for example, if you invest in Reliance, you see, any deposit if you give to Reliance company, it is good. So then on the other hand, you can invest in shares, some risky, you see, business also you can invest. There are chances you may get more interest. There are chances you may not get much interest compared to, you see, bank. So in finance, risk refers to the variability or uncertainty of returns associated with an investment. Unlike its everyday usage, where it often implies only negative outcomes, in investment, risk encompasses both the probability of losses and the possibility of lower than expected, you see, returns. When an investor buys a financial asset, they anticipate a return, you see, they expect some return. Suppose you invest in bank, so you know that after 1 year bank will give you money, return, interest. Bank can give you interest quarterly also, monthly also, as per your requirement. However, since future returns are uncertain, this element of unpredictability, you see, constitutes risk. But at certain places, say, for example, if you invest in post office, in bank, you know the rate of interest, percentage of rate of interest, what they are going to give you, and you will know that after 1 year you will get this much amount. So in finance, risk refers to the variability or uncertainty of returns associated with an investment, unlike its everyday use, where it often implies only negative outcomes. In investment, risk encompasses both the probability of losses and the possibility of lower than expected returns. Suppose you expected 10%, but you may get 10%, 9%, you see, 8%. The investor buys a financial asset, they anticipate a return. If you invest money in any financial assets, so you are expecting return. Either through price appreciation, you see, your security value may rise, or you see, you may get regular income. However, since future returns are uncertain, you see, you don't know what are going to be the returns. This element of unpredictability, you see, constitutes risk. Now the risk comes into the picture because you don't know how much return you are going to get. If the company, you see, earns more profit, naturally it will give more dividend to its shareholders. You see, price of the share will also increase. If the company, you see, makes less profit or goes in loss, naturally they will not pay you any dividend, you see. And the share value of your share will also go down. Risk is inherently tied to return. Risk is directly related to return. The more you take return, the more will be risk. The less you take risk, the less will be return. The more you take risk, you can have more, return also. You may not get more return also. Both. Investors generally expect a higher return as compensation for assuming greater risk. For example, government bonds are considered risk-free due to, sovereign, backing, while corporate debentures, even with safeguards, carry some risk due to business performance, uncertainty. You don't know how the company is going to do. If the company doesn't do well, naturally it will give less dividend. Or if the company goes in loss, company will not give any dividend to the shareholders. Thus, while a 12% 2020 Government of India loan is, virtually riskless, a 14.2% 2005 TISCO NCD includes potential business related uncertainties. Investor attitudes vary. Risk averse individuals prefer stable returns even if lower, while speculators seek, high returns and are comfortable with variability. Normal investor, he will feel that my principal should be safe and I should get some interest. But a speculator, he wants more, interest. A balanced financial system needs both types. The volatility in return and the volatility in the return determines the investment's risk level. Investors are generally rewarded for bearing more risk with, potential higher returns. Again same, directly related return is directly related to risk. The more risk you will take, the more return you can earn. Investor attitudes vary. Risk averse individuals prefer stable returns even if lower, while speculators seek higher returns and are comfortable with variability. A balanced financial system needs both the types. The volatility in return determines the investment's, risk level. Investors are generally rewarded, for bearing more risk with potentially, higher returns. Earlier financial analysis judged risk based on observable company traits, particularly in its debt levels. Debtors, they are not paying money, bad debts, they become bad debts. That used to be the risk earlier. High leverage, was perceived to increase investment risk. People used to think that in the balance sheet, if there is, more debtors, liabilities, company has to give money. So they used to feel that the company is not, good. They never used to invest in that. In the foundational work, security analysis, Graham, Dodd and Cottle introduced the concept of, margin of safety. The difference between the security's intrinsic value and market price as a measure of risk. A larger margin, signified, lower risk. So these two scientists, they gave this theory, margin of safety. It is the difference between a security's intrinsic value and the market price. Evaluation of, risk connotations. Over time, statistical tools like standard deviation, range, semi-variance and mean absolute deviation became prevalent for quantifying risk. These are the measures of risk. The standard deviation gained popularity due to its, compatibility with probability distributions. Risk can be classified broadly into systematic risk, unsystematic risk. Unsystematic risk and systematic risk. Systematic risk is common to all securities and non-diversifiable. For example, you see there is a bad political situation in Pakistan. Nobody will like to invest there because systematic risk is there. Unsystematic risk specific to a company or a sector. You see now, systematic risk affects the whole market, like inflation. Inflation will affect the entire market. Interest rate, if Reserve Bank has lowered the interest rate, it will affect the entire market. If Reserve Bank has increased the interest rates, it will affect the whole market. Then political stability. If the government of a country is not politically stable, say Pakistan, people will not like to invest there, you see money. Then unsystematic risk, it relates to one company, specific to one company or industry. Example, a fire in a company's factory or poor management. Suppose there is a fire in company's premises or the management of the company is poor. You see, this is your unsystematic risk because it is regarding that particular company. You can reduce unsystematic risk by investing in different companies, you see. Now we come on the next. Investors encounter multiple sources of risk that contribute to return, you see, variability. Higher the risk, higher the expected return, lower the risk, lower the expected return. Now next is, you see, sources of risk. What are the sources of risk? The first source is market risk. Market risk arises from price fluctuations due to investor sentiment, economic events or political changes. Even without a change in a company's performance, stock prices may swing drastically due to general market psychology, bull bear phases or economic cycles. This risk is largely systematic, affecting all the shares, though some securities may behave contrary to the market due to unique positive developments. Next is interest rate risk. Reserve Bank lowers the interest, Reserve Bank increases the risk interest. Changes in interest rates directly affect the valuation of fixed income securities. Suppose you have invested in the bank, where fixed your returns are fixed. So interest rate risk will affect such securities. When rates rise, existing bond prices fall, and vice versa, due to the inverse relationship between the price and the yield. This risk influences not only bonds but also equity valuations indirectly, as investor expectations shift in line with the risk-free rate. Next is inflation risk. This refers to the loss of purchasing power due to rising prices. When the prices rise, the purchasing power is lost. While returns may appear satisfactory in nominal terms, inflation adjusted returns real returns could be minimal or negative. An investment that doubles in nominal value during a period of tripled inflation effectively yields a loss in real terms. Next type of risk is business risk. This type of risk stems from fluctuations in earnings due to industry specific or company specific factors like government policies, competition, business cycle or economic downturns. It is unsystematic in nature and can be, you see, reduced through portfolio diversification. What is portfolio diversification? Suppose a retired person, now he is not going for job, his income is only by his investments, whatever he has earned in the life, you see, earlier. Now he will invest some money in bank, he will invest some money in post office, he will invest some money in shares, he will buy some debentures of good companies like that. You see, he is not going to spend the entire money at one place, invest in entire money in one place. Small amounts he will give, you see, invest, and this is what is, you see, basket of investment. This is his basket of investments, and this is his portfolio consisting of so many securities. So I wanted to explain the meaning of portfolio now. Now I think you got it. Now business risk, this type of risk systems, this type of risk stems from fluctuations in earnings due to industry specific or company specific, you see, factors like government policies, competition, business cycles or economic downturns. It is unsystematic in nature and can be reduced through portfolio diversification. You invest in various securities, so that is portfolio diversification. Next is financial risk. Financial risk, it arises from the use of debt, leverage in the capital structure. While it can be amplify returns during good times, it also increases the risk of financial, you see, distress during downturns. High leverage can lead to difficulty in, you see, debt servicing, reduced creditworthiness, and even, you see, bankruptcy. Now we come on, you see, next type of, you see, risk, management risk. Sometimes, you see, the top people, management in a company is not good, so company doesn't, you see, earn much profit. The moment the top management is changed, new directors come, company starts making profit. This means the working of the earlier management was not good, you see. So management risk is, this results from poor decisions by the management team, errors such as, you see, ignoring product obsolescence, over reliance on a single customer, or failure to invest in innovation can lead to significant losses, you see. According to agency theory, managers may pursue personal benefits over shareholder value, especially when they do not, you see, own equity in the future. This leads to an, you see, agency cost, which represents the difference in the value between owner managed and managed, you see, manager managed firms. If the owner is managing and if the manager is, you see, managing, you have to give salary to the manager, you see. So this is about, you see, management risk. Now we come on the, you see, next risk, that is liquidity risk. Suppose you are working in a branch, you see, on the maturity date, your FD customers, they come and take back money from you. You cannot tell them that we are not having money today, you see, you can't give you. No, you have to pay them. If the FD is matured today, you have to pay the money to the customer today only. So liquidity risk means, suppose the position liquidity is not there, that is risk is there. This risk refers to the inability to sell securities of fair market value due to low trading volume or, you see, market depth. Illiquid assets often requires discounts or incur high transactions cost to convert to cash. Social or regulatory risk, rules and regulations, see, Reserve Bank changes. Government interventions such as price controls or taxation nationalization or legal regulations can negatively affect business operations and investment value regardless of a firm's performance. Now, types of risk: systematic risk, uncontrollable market-wide risks that affect all securities and cannot be eliminated by diversification. Examples are change in monetary policy, inflation trends, economic downturns, interest rate hikes. Systematic risk is measured using beta, which indicates a stock sensitivity to market movements. A beta more than 1 means higher volatility than the market. Less than 1 means lower volatility. Next is uncertainty risk. It is firm specific, arising from management inefficiencies, operational issues, or company specific events. These can be diversified by holding a broad portfolio across sectors. Examples are strikes, labor is on strike, research and development failure, losing a major customer, legal issues. So unsystematic risk can arise due to these strikes, research and development failure, losing a major customer, legal issues. Now, risk versus uncertainty. Risk probabilities of outcomes are known, uncertainty probabilities are unknown. Investors prefer to operate under risk rather than uncertainty because it allows for better decision making using expected return models. Measuring historical return. The total return on investment over a period includes both cash income, that is dividend, interest, and capital gain or loss. That total is known as historical return. Now, they have explained here how it is measured. Total return R is equal to C plus PE minus PB divided by PB. C is cash payment, P is ending price, PB is beginning price. Risk is measured as the variability of returns. The most common statistical tools are variance and standard deviation. Now, standard deviation formula is standard deviation is equal to under root 1 divided by n minus 1 summation RT minus R whole square. RT RI minus R bar, that is mean R whole square. This is standard deviation. Given 6 years return, 16%, 20%, 22, 20, 13, 15, 10. Mean is equal to 10%. If we add all and divide by 6, we get 10. Then variance is equal to 138.8. Standard deviation is equal to 11.78. Higher deviation implies higher risk. So higher is the deviation, higher will be the risk. So standard deviation is 11.78. So risk is more. Measuring expected return and risk. This section covers ex ante future based expected return using probability and distribution. Expected return, then standard deviation of return. Now, risk and return are interlinked concept in finance. Investors mostly are risk averse. They want that we should get our full principal plus interest. Aim for optimal returns with minimum risk. Total risk includes systematic and unsystematic components. While the former is market wide and non-diversifiable, the latter can be managed through portfolio diversification. Portfolio diversification means you should have a number of securities in your basket. Don't depend on one security. Suppose it is bank fails. Investment risk is quantified through measures like standard deviation, and expected return is calculated by a probability weighted average. These leads to help investors make a informal decision and align choices with risk appetite. Now we have come on the next chapter, that is valuation of securities. What is the value of the securities? Now you deposit 1000 rupees in a bank today. Bank is giving you 6% per year on your fixed deposit. So after 1 year you will get, you have deposited, say for example 1 lakh, you will get 6,000 interest, 6%, 1 lakh 6,000. Very safe investment. Now, valuation is a process that determines the present worth of a company's equity or its net opening assets based on expected future value, future cash flows. These, cash flows can take the form of dividends, cash flows to shareholders, free cash flows, or abnormal, earnings. The valuation process typically divides the future into two parts, that is explicit forecast period where cash flows are estimated year by year, and a terminal or post horizon period where assumptions about perpetual growth are applied. Now, valuation extends beyond just securities. It includes tangible and intangible assets. Tangible, you can touch, intangible, you cannot touch, say for example, goodwill, it is an intangible asset. It is essential to consider value, drivers, economic and competitive conditions, and choose the appropriate method suited for the asset or business being valued. With increasing privatization, the subject has become, economically and politically significant. Genesis of valuation. Valuation is a complex contextual exercise. There is no universally fixed method for every scenario or company's different structure, operations, and financing. A rational and scientific approach is, required based on proper financial data, analytical techniques, and expert judgment. Genesis of valuation. An effective valuation exercise should lead to a fair and reasonable conclusion. Use transparent procedures. Involve interdisciplinary, expertise, finance, economics, engineering. Be free of bias and withstand critical scrutiny. Produce a detailed report accepted as, accepted as a credible, scrutiny. So, an effective valuation exercise should lead to a fair and reasonable conclusion. Your conclusion should be, reasonable, it should be fair. You should use transparent procedures. Involve interdisciplinary expertise, take the help of, experts, that is experts in finance, economics, and in engineering. Be free of bias, you should not be biased, and withstand critical scrutiny. Produce a detailed report accepted as, credible testimony. Now need for valuation. Why? What is the need for valuation the securities? Why do you want to value the securities? Why do you want to need the business? Business valuation is a vital for several stakeholders, you see, including investors, business owners, regulators and legal entities. Suppose you want to invest, you buy Reliance shares. Suppose you want to put in shares, money. So you will buy Reliance shares and then you will forget, you see. You know its value will keep on increasing slowly. So Reliance is a good company. It will give me good dividend as well as my principal value will increase. Similarly, if you don't want to take much risk, you can invest in a bank, you see. Your principal will be intact. Bank can service the interest as per your requirement. So many retired people are there. Like pension, every month they get interest because they have made the investment in the bank. Banks in our country are safe. Your money is 100% safe. There is insurance also up to 5 lakhs. Plus, secondly, if a bank fails, you see, government merges it with another bank. Nothing, no loss happens to the depositors. Bank runs only because of depositors. You see, if there is money with the bank, it will lend the money to the people, you see. That is how bank runs, accepting money from the people and lending it to the people who are needing it, who are doing business, or otherwise also who are needing. You can, you see, sanction various types of loan, personal loan, car loan, housing loan, mortgage loan, reverse mortgage loan, consumer loan, bike loan. So many types of loans are there, you see. Now students also, nobody should be deprived of studies. If anybody is a good student, good academic record, he can take bank loan and no bank can refuse him to give loan. That is government scheme, and then he can study further. Government of India wants that everybody should study, you see. If a person is not having money, he should not be deprived of studies. Government is there to help him. So, business valuation is a vital for several stakeholders, including investors, you see, business owners, regulators and legal entities. While stock market prices provide a daily valuation, you see, they are influenced by speculation. What do you mean by speculation? One is gambling. What do we mean by gambling? Gambling means, suppose you buy a lottery ticket, you see. Either you will get the prize or your money goes. It is gambling. You invest money in a horses. You see, if the horse wins, you will get money. Otherwise, you see, you will lose. So this is what is cards. People play cards also with money. So this is, you see, gambling. Then speculation. Suppose you have invested, you see, 1 lakh rupees today in, you see, Reliance shares. Tomorrow, you see, 2 rupees per share increases and you see, you sell those, you see, 1 lakh shares. So you will earn 2 lakh rupees because the price in which you bought, that was less than, you see, by 2. So this is what is speculation. You are investing for the purpose of, you see, earning profit, quick profit. You don't want to wait and hold, you see. Same shares, Reliance, if you keep for 1 year, 2 years, the price will be much more. So stock market prices provide a daily valuation. They are influenced by speculation, investor, you see, sentiments and macroeconomic variables, you see, making them unreliable for long-term analysis. Certified valuation experts therefore provide more objective and detailed analysis, you see, using structured methodologies. Valuation is needed in scenarios such as, you see, merger, acquisitions, legal disputes, then tax assessments, investment decisions and strategic, you see, planning. Various, you see, expressions of value. Fair market value. What do you mean by fair market value? The price at which a willing buyer and seller agree to transact in a competitive market without any coercion. It is used in statutory valuations, especially for dissenting, you see, minority shareholders during mergers or takeovers. So they have explained by example also. So fair market value, fair market price, the price at which a willing buyer and a seller agree to transact in a competitive market, that is fair market price, without any coercion. It is used in statutory valuations. Next is book value. Now also called net book value or shareholders equity. This is the difference between total assets and liabilities on a company's balance sheet. It is based on historical cost and depreciated asset values. That is what is book value. Now we come on intrinsic value of an asset. This refers to the true economic worth of a security based on its expected earnings and quality. It is calculated as the present value of future earnings using reasonable assuming and internal benchmarks. So intrinsic value is the true economic worth of a security based on its expected earnings and quality. It is calculated as the present value of future earnings using reasonable assumptions and internal benchmarks. Now replacement value. The current cost of replacing an asset with another of similar function, their function should be same, using modern technology. It differs from reproduction cost, which replicates the original asset identity. So replacement value, what is replacement value? The current cost of replacing an asset with another of similar function using modern technology. Now various expressions of value. Liquidation value, what we get at the time of liquidation. The amount realized if a business shut down and the assets are sold. It includes orderly liquidation, assets sold over time, forced liquidation, assets sold quickly, often at a discount. If there is a forced liquidation, you have to liquidate your assets. So assets are sold quickly, often on discount. If it is orderly liquidation, assets are sold over time. Now business valuation methodologies fall into three broad categories. This approach values a business based on its future earnings potential discounted to present value. Capitalization method, appropriate for stable businesses. Earnings are capitalized using a rate discounted growth rate. Now everything in between you will not be paid interest, it is accumulating with the principal. This is known as capitalization method. You invested 10 lakh rupees in the bank for 5 years, after 5 years you will come. Now discounted cash flow, DCF method, suitable for businesses with fluctuating earnings. Forecasted free cash flows are discounted at the cost of capital to arrive at net present value. Discounting means, suppose you have taken some bills to the bank, to your banker. Those bills are, you have drawn on your buyer at Bombay. So you can discount these bills. Bank will discount these bills. Bank will give you money. On the due date, bank will recover from the those people on whose instruction bills were drawn. So bank will collect, because in that it is mentioned that they have to pay the money and Mr. So and so has to receive the money. Now instead of so and so, now bank is going to receive the money. So this approach values a business based on its future earnings potential discounted to present value. Capitalization method, appropriate for stable businesses. Earnings are capitalized using a rate, discount rate or growth rate. Discounted cash flow, DCF method, suitable for businesses with fluctuating earnings. Forecasted free cash flows with are discounted at the cost of capital to arrive at a net present value. Now we come on market approach. This method compares the business to similar publicly traded companies or recent transactions in the market. Valuation is done using ratios like price to earning ratio, price to book ratio, EV divided by EBITDA, earnings before interest, tax, and they have mentioned other expenses. So this was about market approach. What market approach says? This method compares the business to similar publicly traded companies or recent transactions in the market. Valuation is done using ratios like price to earning ratio, price to book value ratio, then EV divided by EBITDA. Next is asset approach. Based on substitution principle, it calculates the net asset value, NAV, net asset value. Useful for asset, heavy businesses or when liquidation is under consideration. Net asset value per share is used simply to earnings per share in earnings based valuation. So the formula is net asset value is equal to total assets minus total liabilities. They are the net assets. Now investment decision required rate of return. Investors aim to earn return that compensate for time preference of money, expected inflation, risk taken. The required rate of return serves as a benchmark to evaluate investment attractiveness. For known cash flow instruments like FDs or bonds, decisions are easier. For equity investors, must forecast future cash flows, making decision making more complex. Also known as a top down approach, this method evaluates economy, industry, company. Economy, industry and company. Now economic analysis, macroeconomic indicators like fiscal policy, interest rate, inflation, government spending and international events are studied. These factors influence business performance and investors confidence. Next we come on industry analysis. Each industry reacts differently to business cycles. Clinical industries, that is steel, automobiles, perform well in booms but suffer in recessions. Non-cycling industries, that is FMCG products, pharma, are more stable. Now company analysis. While within a promising industry, individual companies are evaluated for past and projected performance. Projected performance means how much is going to be your sale in future, this current year, next year, then next year. You have to project, and what is your project report, how you are going to increase this sale, what are your plans, are you going for expansion, for opening a new branch. So you have to tell to the bank. So within a promising industry, individual companies are evaluated for past and projected performance, market share, management quality, competitive position. Investors seek undervalued companies with strong growth potential, not necessary industry leaders. Now basic valuation model. Value, present value of expected future cash flows discounted at a risk adjusted rate, or PV. Present value is equal to summation T1 to 9 CFT divided by 1 plus R raised to power T, where CFT is equal to cash flow at time T, R required rate of return, and due to changing expectations and new information, due to changing expectations and new information, values you see fluctuate over time. Now investor actions against you see market prices toward intrinsic value: buy when price is less than value, sell when price is more than value, hold when price is equal to value. These actions generate you see buying selling pressures influencing market dynamics. So buy when price you see is less than value, sell when price is more than value, hold when price is equal to value. This formula you remember in case of shares. Next is it distinguishes you see between professional investors act on superior information and correct value price mismatches. Unsophisticated investors react emotionally or to public news, causing price distortions. Ultimately, professional activity you see restores equilibrium. Valuation is continuous as new information, financial, political, economic, leads to revisions in expected returns, risk, and therefore intrinsic value. Now, valuation of fixed income securities, you see. For example, you invested, you see 1 lakh rupees in the bank for 3 years, rate of interest is 10%. Now, what amount bank will give you after 3 years if you did not take the interest in between? You have to mention that whether you want interest to be serviced or interest to be compounded. So, in this formula, the value of bonds and debentures is the present value of future coupon payments and principal. PV is equal to summation T is equal to 1 to 9 C divided by 1 plus R raised to power N plus TV divided by 1 plus R raised to power N, where C is coupon payments, TV is terminal value or maturity value, R is discount rate or market yield. For semi around both, divide coupon and rate by Z and double the number of people you see. Next is you see bond return metrics. Coupon bond means fixed income payment as percentage of face value. They will give you coupons in the beginning only when you invest. Most of the companies. Current yield is equal to annual coupon divided by you see current prices. Next, validity, yield to maturity, the internal rate of return of all future cash flows, interest plus principal to current market price, usually calculated using trial and error or internal rate of return functions in Excel sheet. Preference shares often offer fixed perpetual dividend. This value is V is equal to preference is equal to D divided by KP raised to power you see 8 VP8. Now D is annual dividend, KP8 is equal to required rate of return. If dividends are known and the market price is available, the yield can also be calculated. Next is equity valuation is complex due to variable dividends. The dividend discount model is the core approach. Zero growth model is equal to P0 is equal to D by K. By constant growth model, Gordon growth model, P0 is equal to D1 divided by K minus 7, K minus 9, where D1 is dividend next year, G is constant dividend growth rate. Next is multiple growth model, divides the future into high growth phase 1 to T years, PV calculated for each year. Second, stable growth phase from 1 year plus 1 onwards, DDM applied for terms. Now P0 is equal to summation T is equal to 1 to T dt divided by 1 by K raised to 1 power T plus dr plus 1 divided by k minus 9 into 1 plus k raised to power t. This method uses earnings and an expected or industry wage PE multiple. Share price is equal to earnings per share multiplied by PE ratio. A higher PE implies higher, expected growth or lower perceived risk. It is appreciated tool in real world equity, valuation. Now we come on the summary. Valuation is central to financial decision making. It uses future cash flows and discount rate to estimate intrinsic value, while fixed income security valuation is straightforward. Equity shares deeper analysis due to variable dividends and growth expectations. Models like DDM, zero variable dividends and growth model like DDM, zero constant growth model, and the PE approach are widely used. Accurate valuation supports rational investment decisions, especially when comparing intrinsic value with market prices. So in this particular chapter we have studied risk and return. We have seen the more risk you will take, you can get more returns also. Now returns means the gain or loss you get from an investment. It can come from two things: income, the interest or dividend; capital gain or loss, increase or decrease in the value of your investment. Then what is risk? Risk means the uncertainty about the return. You don't know exactly how much you will earn or lose. Types of risk are systematic risk, affects the whole market. Examples, inflation, interest rate changes, political stability. You cannot avoid this by diversification. Unsystematic risk, specific to one company or one industry, one business house only. Example, a fire in a company's factory or poor management. You can reduce this by investing in different companies. Diversification, divert your portfolio. Interest is many securities. Don't invest in one security, invest in many securities. Next is compounding and discounting. Compounding, finding future value; discounting, finding present value. Then why time value money is important in financial management: to decide whether to invest today or later, to compare projects that have cash flows at different times, to calculate loan, EMIs, bonds and retirement plans. Now next is higher the risk, higher the expected return; lower the risk, lower the expected return. This is the golden rule. Now time value of money, the value of money changes over time. Rupees 100 today is worth more than rupees 100 after 1 year. This is because money today can be invested and earn interest. Future value, it means how much the money today will become in future. That is future value. Formula you all know: FV is equal to PV into 1 plus R raised to power N. Where PV is equal to present value, R is rate of interest, N is number of years. Now present value, it means how much a future amount is worth today. Reverse of future value. It means how much a future amount is worth today. Formula is PV is equal to FV divided by 1 plus R raised to power N. Then we come on annuity, a series of equal payments made at regular intervals, compounding and discounting, compounding the finding future value, money grows forward, discounting finding present value, money goes backward. Why time value money is important in financial management? To decide whether to invest today or later, to compare projects that have cash flows at different times, to calculate loan, EMIs, bonds and retirement plans. So we have studied risk and return. We saw concept of investment risk, then evaluation of risk consumption, then sources of risk, market risk, we saw interest rate risk, inflation risk, business risk, financial risk, management risk, liquidity risk, systematic risk, unsystematic risk. So these are all types of risks which we have covered. The first is market risk. Market goes up and down. Market risk arises from the price fluctuations due to investor sentiment, economic events or political changes. Next is interest rate risk. Changes in interest rates directly affect the valuation of fixed income, securities. When interest rates rises, people sell the securities. When interest rate decreases, people buy the securities. Inflation risk. Inflation risk refers to the loss of purchasing power due to rising prices. Whatever is 100 rupees, 6 months back, you used to get something. Now, if same amount you pay, the quantity which you will get will be less because price has become more. So inflation risk means loss of purchasing power due to rising prices. Then business risk. This type of risk stems from fluctuations like government policies, competition, business cycles or economic downturns. It is unsystematic in nature and cannot be reduced through portfolio diversification. Now sources of risk are financial risk, sources of interest are interest rate risk, then inflation risk, business risk, financial risk, management risk, liquidity risk, social or regulatory risk. Then we studied systematic risk. Systematic risk, uncontrollable market wide risks that affect all securities. All securities are affected by this and cannot be eliminated by diversification. Unsystematic risk, it is firm specific, firm specific risks arising from management inefficiencies, operational issues or company specific events. These can be diversified by holding a broad portfolio across sectors. The factors are strikes, research and development failure, losing a major customer, legal issues. Now, next is risk probabilities of outcomes are known, uncertainty probabilities are unknown. Investors prefer to operate under risk rather than uncertainty because it allows for better decision making using expected return models. The total return on investment over a period includes both cash income, that is dividend interest, and capital gain or loss. Both. Suppose dividend you get 5 rupees and your asset has increased 10 rupees. So your income will be 15 rupees. Then we studied formula. Total return R is equal to C plus PE minus PB divided by PB. Then risk is measured as a variability of returns. The most common statistical tools are variance and standard deviation. Then again we studied the formula. Then we saw valuation of securities. Now, valuation of securities. Valuation is a central to financial decision making. It uses future cash flows and a discount rate to estimate intrinsic value. While fixed income security valuation is straightforward, you know how much return you are going to get. In the beginning only, suppose you invest in a good company, he will give you interest checks, post-dated checks. January last date, February last date, March last date. For example, it is 3 years, you see. So they will give you, you see, installments in the beginning only, they will pay you by means of post-dated checks. So students, we are closing our session. Thank you very much, students.